In this interview, renowned investor Warren Buffett shares his insights on the recent market volatility and its impact on retail investors. Buffett, known for his successful long-term investment strategies, emphasizes the importance of maintaining a disciplined and rational approach to investing, even in the face of turbulent market conditions. Buffett discusses the psychological aspect of investing, highlighting the challenges that many individuals face in staying the course during periods of market stress. He also addresses the trend of people gambling in the market by purchasing complex financial instruments they don't fully understand, emphasizing the importance of focusing on the fundamentals of a business rather than chasing quick profits. Throughout the interview, Buffett consistently favors equities, explaining that low interest rates significantly boost stock prices. He also challenges the conventional advice that suggests a specific percentage of one's portfolio should be allocated to bonds, arguing that this rule of thumb is not suitable for everyone.
Our special guest this morning is the chairman and CEO of Berkshire Hathaway, Warren Buffett. And Warren, we've talked about a lot of things this morning. We got briefly your thoughts on the markets, but there's been a lot that's happened in the markets since the last time we sat down with you. Volatility is back in a big way, and that has the average retail investor kind of questioning what to do at this point. It's scared a lot of people. What do you think's happening right now, just in terms of the return of volatility? Is it something to be worried about? What's causing it?
Well, if you own stocks like you'd own a farm or an apartment house, you don't get a quote on those every day or every week. And I think you look at the business, and the value of American business depends on how much it delivers in cash to its owners over between now and Judgment Day. And I don't think it changes in 10% in a 2-month period if you're looking at it as a business. Now you've got anything can happen in markets. I mean, anything can happen in markets, and that's why I say don't ever borrow money against securities. That markets don't have to open tomorrow. I mean, you can have extraordinary events. So I think to some extent you can get some of the instruments that people don't understand very well that have a lot of firepower in them,
like
and
the volatility
they
index
can trigger.
And things that are tied to that.
The idea of people taking a position, and they're gambling. They're not investing. Nobody's investing when they buy, some supercharged index on how the VIX does or something like that. They don't need it in their life. It's an unnecessary instrument. Now, they will create instruments that the public will buy, and you can just count on that. Wall Street's been doing that since they met under the Buttonwood tree in 1792 or whatever it was on the exchange. So, but if you're investing, if I'm going to buy a half interest in a McDonald's stand and you're going to run it, or McDonald's franchise, you're going to run it, I look to the business to determine whether I made a good investment. And I'm concerned about, whether we have new competition, how we do over the years. But it's the business I look at. When you're just looking at the price of something, you're not investing. I mean, if you buy something, Bitcoin, for example, or some cryptocurrency, you're not looking to the asset itself to produce anything. If you buy an apartment house, you're looking at how the apartment house does. If you buy a farm, you're looking at the farm does. If you buy a whole business, you're looking at how the business does. If you buy a part of a business, why shouldn't you look at how the business is going to do? But people get charmed by lots of action and the fact that things are liquid and all of that. And it does have repercussions back into the market when you get something like, an ETN arrangement on the, supercharged on the VIX. I mean, where you can lose 90% of your money in one day. I mean, that really doesn't belong with the word investment. I mean, it's a gambling form of activity.
Although you've said yourself, you talked about this in the annual letter over the weekend, and just even at the top of the show, where when you look around for a business that you want to buy, you can't find any at attractive levels. However, when you're looking at equities, you do see that as a good place. The Berkshire has been a net purchaser of equities this year in 2018, and that's because you like the deals that you're getting in the market.
You can buy small pieces of businesses for less than you can buy whole pieces of businesses.
For the premium you'd have to pay if you were buying the whole thing.
Yeah, so you get a bargain as an investor compared to what I can get in terms of buying the whole business. And people, if they just think of stocks as pieces of business, they'd be so much better off than thinking of those little things that move around in price. And I think with Berkshire, we have an unusual number of people as shareholders who just look at Berkshire as a business. They look at it as a savings account. They put some money in 20 or 30 or 40 years ago. We retain it and reinvest for them, but we're their savings account. And That's the way I look at my own stock. That's the way Charlie looks at his stock.
Part of the reason that you've been so bullish on equities for many years at this point is the interest rate environment.
Yeah.
You've looked at interest rates and said interest rates are gravity on stock prices, and when interest rates are so low, stock prices inevitably are going to climb. There's been this really weird thing that's been happening in the markets where all of a sudden good news that we got from a good jobs report made people start to worry that interest rates were going to climb and that the Fed was going to raise rates more than anticipated. People got really nervous around that, and you can still see it every time we get up on the 10-year back towards 3%. It gives investors, or at least traders, I should say, some concerns about what's happening. How do you kind of gauge all
A
of that?
bond, if you buy a 30-year government bond, it has a whole bunch of coupons attached. In the old days, it does now, it's electronic. But it has a whole bunch of coupons. And the coupon says 3% or whatever it may say. And you know that's what you're going to get between now and 30 years from now, and then they're going to give you the money back. What is a stock? A stock is the same sort of thing. It has a bunch of coupons. It's just they haven't printed the numbers on them yet. And it's your job as an investor to print those numbers on. If those numbers say 10%, and most American businesses earn over 10% on tangible equity, if they say 10%, that bond is worth a hell of a lot more money than a bond that says 3% on it. But if that government bond goes to 10%, it changes the value of this equity bond that, in effect, you're buying. You are buying, when you buy an interest in General Motors or Berkshire Hathaway or anything, you are buying something that over time is going to return cash to you. Maybe a long time in terms of Berkshire, but it'll be bigger numbers. And those are the coupons, and it's up to you, your job as an investor, to decide what you think those coupons will be, because that's what you're buying, and you're buying the discounted value. And the higher the yardstick goes, and the yardstick is government bonds, the less attractive these other bonds look. And that's just fundamental economics. So in 1982 or 3, when the long government bond got to 15%, a company that was earning 15% on equity was worth no more than book value under those circumstances, because you could buy a 30-year strip of bonds and guarantee yourself for 15% a year. And a business that earned 12% was a subpar business then. But a business that earns 12% when the government bond is 3% is one hell of a business now, and that's why they sell for very fancy prices.
So 3% is a long way from 15% that you were just talking about. But
I watched it go from 3 to 15, though, too.
Right. Is there an inflection point on that way? Because people think, oh, my gosh, we've gone from 2.4% to 2.9%, and that's a big difference.
That's not much.
Historically speaking, that's still the way we should be measuring these things, not on the absolute movement or the percentage gain movement over time.
2.4 to 2.9 is nothing if you're comparing it with businesses that earn 12% on equity and reinvest. And the S&P, you can just look at the figures for decades, has earned on tangible equity. It's earned a lot more than that, and it translates into higher prices, and it should.
Is there a tipping point along the way, or is it a gradual decline in terms of these things?
Nobody knows. Yeah, but it is gravity. I mean, if you told me interest rates were going to be 15% next year on long bonds, there's a lot of equities I wouldn't want to own now, and I would buy a lot of governments at 15, and I kind of wish I had it in 1982, but I didn't.
If I told you that the long bond was going to trade at 4.5% to 5% next year,
it makes a difference. But it's been idiotic to own long bonds during the last. I talk about this in the report in terms of it's just been idiotic, and big public pension funds and all.
Warren Buffett discusses the recent market volatility and its impact on retail investors. He advises against constantly checking stock prices, likening it to owning a farm or apartment house where daily quotes are irrelevant. The true value of a business, he explains, lies in the cash it generates over time, not its short-term stock price fluctuations. Buffett emphasizes the importance of focusing on the business's fundamentals and long-term performance rather than getting distracted by daily market movements. The trend of people gambling in the market by purchasing complex financial instruments they don't fully understand. He explains that this behavior is not true investing but rather speculative gambling. According to Buffett, genuine investing involves buying shares in businesses that one comprehends and believes in. He advises investors to focus on understanding the business's fundamentals and its long-term potential to generate cash, rather than chasing quick profits through complicated and risky financial products. Warren Buffett has consistently favored equities, emphasizing that low interest rates significantly boost stock prices. He likens interest rates to gravity, explaining that when rates are low, they exert less downward pressure on stock prices, making equities more attractive. This attractiveness is further enhanced by the fact that the coupons on stocks, meaning the dividends or returns they generate, are much higher compared to those on bonds. Consequently, in a low interest rate environment, stocks offer better returns, reinforcing Buffett's bullish stance on equities. Warren Buffett discusses the belief that there is an inflection point at which rising interest rates will negatively impact stock prices. While he admits uncertainty about the exact point, he emphasizes that current rates are still far from the 15% seen in 1982. Buffett highlights that long-term bonds become riskier with longer maturities, contrasting with stocks, which become less risky the longer they are held. This perspective underscores his preference for equities, particularly in a low interest rate environment, as they offer better long-term returns compared to bonds. He challenges the conventional advice that suggests a specific percentage of one's portfolio should be allocated to bonds, such as a 60/40 or 70/30 split between stocks and bonds. He argues that this rule of thumb is not suitable for everyone. Buffett points out that some individuals should avoid owning stocks entirely if they are prone to emotional reactions and poor decision-making in response to market volatility. Essentially, if price fluctuations cause distress, those investors might be better off not owning stocks. Throughout the interview, Warren Buffett emphasizes the importance of maintaining a long-term perspective and emotional discipline when investing. He underscores the significance of understanding one's own risk tolerance and behavior under market stress, as well as the fundamentals of the businesses in which one invests. Buffett's insights serve as a reminder that successful investing requires more than just financial knowledge. It also demands psychological resilience and the ability to stay the course during challenging times. By following Buffett's principles of focusing on the long-term potential of businesses, avoiding emotional reactions to short-term market fluctuations, and tailoring investment strategies to individual risk profiles, investors can navigate the complexities of the market and work towards achieving their financial goals.